In a world where markets rise and fall overnight, true success belongs to those who stay calm and think wisely. Today, we explore The Intelligent Investor, Benjamin Graham's legendary guide to smart, lasting wealth. Benjamin Graham draws a sharp line between investment and speculation. Investment means putting your money into assets, like stocks or bonds, with careful analysis, safety of principle, and a reasonable expectation of return. An investor focuses on long-term stability and value. Speculation, on the other hand, is more like gambling. Speculators chase short-term profits, follow market trends, and rely on luck or timing rather than analysis. Graham explains that most people who think they are investors are often speculating without realizing it. The danger? Speculators expose themselves to unnecessary risk, disappointment, and even financial ruin. To be an intelligent investor, you must protect yourself against mistakes. Avoid overconfidence and think in terms of years, not days. Chasing hot tech stocks, crypto trends, or can't miss opportunities is usually speculation, not true investing. True investors accept that they won't beat the market overnight. Instead, they focus on steady, disciplined growth. Markets are unpredictable, but if you follow principles of safety, patience, and analysis, you can protect yourself and achieve success over time. Being an intelligent investor isn't about being flashy or lucky. It's about discipline, patience, and separating yourself from the crowd. Benjamin Graham stressed a reality that every investor must face: inflation. Over time, the cost of living rises and the purchasing power of money shrinks. This means that simply holding cash is not safe because inflation slowly eats away at its value. Bonds and fixed income investments. Graham warns that while they may seem safe, in times of high inflation, they can actually be very risky. Why? Because the fixed interest payments lose value as prices rise. Historically, stocks have offered better protection against inflation since businesses can raise prices and grow profits over time. But Graham cautions, stocks are not a perfect hedge. In the short run, inflation can cause markets to be volatile and unpredictable. There is no single investment that perfectly shields you from inflation. An intelligent investor balances risk by diversifying and by staying realistic about what inflation means for long-term wealth. Many investors mistakenly believe that real estate, gold, or new assets like cryptocurrencies are guaranteed hedges. These can rise and fall dramatically, and no asset is immune to risk. The practical solution for today's investor is diversification, a balanced mix of stocks, bonds, and inflation-protected securities. Graham points out that markets move in cycles: periods of extreme optimism, bull markets, and deep pessimism, bear markets. Neither lasts forever. By 1972, the U.S. stock market was at historically high levels, especially with the Nifty 50 stocks, a group of glamorous companies considered so reliable that people thought they could never fail. Investors believed these stocks were safe at any price. Graham warns, no stock is safe if you overpay for it. Even great companies can become bad investments if bought at inflated prices. Markets will always swing between greed and fear. Intelligent investors avoid being swept away by either extreme. Look beyond the hype. Study the past to recognize patterns of speculation and overvaluation so you don't repeat the same mistakes. Markets may change, but human nature doesn't. People will always chase the next big thing. Intelligent investors must resist this temptation. The best defense is discipline. Diversify your holdings. Avoid paying too much for popular stocks. And remember that every bubble eventually bursts. Benjamin Graham introduces the concept of the defensive investor, someone who doesn't want to spend too much time or energy analyzing the market, but still wants to protect and grow their wealth sensibly. A defensive investor values safety and simplicity. Instead of chasing big wins, they focus on avoiding big mistakes. Graham suggests a balance between stocks and bonds. The classic rule: never hold less than 25% in bonds or more than 75% in stocks, and vice versa. In most cases, a 50-50 split between stocks and bonds is a sensible middle ground. Stocks provide growth potential to protect against inflation, while bonds add stability and reduce volatility. The defensive investor avoids speculation, ignores market predictions, and stays disciplined with a long-term plan. For ordinary investors who don't want to gamble or spend all day studying companies, the defensive approach, balanced, steady, and disciplined, is the safest path to success. Modern investors can easily apply the defensive strategy using index funds. For example, a simple portfolio of a total stock market index and a high-quality bond index achieves Graham's vision of balance and safety. The true strength of the defensive investor is patience. By sticking with a disciplined plan, ignoring short-term noise, and rebalancing when needed, they quietly build wealth over time. You don't have to be a genius to invest well. If you want peace of mind, follow the defensive path. Keep it simple, keep it balanced, and let time do the heavy lifting. Benjamin Graham explains how the defensive investor can safely approach the stock market. Unlike the aggressive investor who spends time researching and taking risks, the defensive investor wants reliable, steady returns with minimum effort. Graham recommends focusing only on large, financially strong, and established companies with a long history of paying dividends. He emphasizes diversification, owning at least 10 to 30 different stocks to reduce risk. No single company should make or break your portfolio. Avoid flashy, hot growth stocks that everyone is chasing. These are usually overpriced and more speculative than safe. Instead, look for value and stability. The goal is not to beat the market but to achieve steady, dependable growth over time. Defensive investors should buy safe, dividend-paying companies, diversify widely, and avoid speculation. Slow and steady wins the race. The modern defensive investor's advantage is simplicity. By consistently investing in low-cost index funds, reinvesting dividends, and holding long-term, they automatically capture the market's growth without the risks of speculation. The defensive investor doesn't need to predict the future or outsmart Wall Street. They just need discipline, patience, and a smart system. And over the long run, that's enough to succeed. Benjamin Graham shifts from the defensive investor to the enterprising investor, someone willing to put in more time, effort, and study in exchange for potentially higher returns. But before saying what an enterprising investor should do, Graham explains what they shouldn't do. This is the negative approach, a list of traps to avoid. Don't buy low-quality speculative bonds just because they offer higher yields. They often bring big risks that outweigh the rewards. Don't chase IPOs, initial public offerings. They're usually overpriced and hyped up, with poor long-term results. Don't blindly follow market trends or hot tips. That's speculation, not intelligent investing. Don't buy just because a stock is popular, glamorous, or the next big thing. Don't trade too frequently. The more you trade, the higher your costs, and the more likely you'll make emotional mistakes. Being an enterprising investor doesn't mean doing more. It means being smarter about what you avoid. Success often comes from refusing bad opportunities, not from chasing every possible gain. The enterprising investor's first weapon is restraint. By saying no to speculation, hype, and overpriced opportunities, they create the space to say yes to genuine value. Benjamin Graham now focuses on what the enterprising investor should do to find real opportunities. The enterprising investor is someone who is willing to put in the time, effort, and discipline to seek out undervalued investments, but always based on logic and analysis, not emotion or hype. Here's what Graham recommends. Look for bargains among undervalued stocks. Focus on companies selling for less than their real worth. For example, stocks trading below book value or with low price to earnings ratios. The goal is to find quality businesses that the market has temporarily ignored or undervalued. Consider special situations. These include mergers, acquisitions, spin-offs, or restructurings, where careful study can reveal profitable opportunities. However, they require deep analysis and patience. Use careful research and independent thinking. Don't follow the crowd or media trends. Instead, study financial statements and company fundamentals. An enterprising investor must develop the habit of thinking for themselves, maintain diversification and emotional control. Even when pursuing higher returns, avoid putting too much money into any one idea. Discipline and humility are essential. No one is right all the time. The enterprising investor earns more not by taking greater risks, but by applying greater effort, patience, and judgment. To be a successful enterprising investor, you must think differently. Ignore the noise, seek real value, and act only when logic, not excitement, says yes. He teaches investors how to think and behave when markets rise and fall, because in the long run, it's your temperament, not your IQ, that determines success. Graham introduces the legendary concept of Mr. Market. Imagine you have a business partner named Mr. Market. Every day he offers to buy your shares or sell you his, but his mood changes constantly. Some days he's euphoric and offers absurdly high prices. Other days, he's depressed and will sell for ridiculously low ones. Your job as an intelligent investor? Take advantage of him, but never be influenced by him. You don't have to act every day. You only act when the market offers you a good opportunity. When prices are below intrinsic value, when prices are high, stay calm and resist the urge to buy more. When prices are low, take advantage, buy quality assets at a discount. In between, hold steady, stay patient. The stock market is there to serve you, not to instruct you. Use its fluctuations wisely, and never let emotion dictate your moves. Benjamin Graham explores one of the most practical questions for everyday investors. What if you don't have the time, skill, or patience to pick individual stocks yourself? His answer, investment funds, which today we call mutual funds or index funds. Graham explains that these funds allow ordinary investors to benefit from professional management and diversification. However, he warns that not all funds are created equal. Mutual funds can be useful, but choose carefully. Some funds are managed by disciplined professionals, but others chase trends or charge high fees. Always look for funds with low costs, conservative management, and consistent performance over many years. Don't chase hot funds. Funds that recently performed well often attract attention, but their future returns usually fall back to normal. Or worse, watch the fees. High management fees, commissions, and trading costs can quietly eat away your profits over time. Prefer simplicity. A few well-chosen low-cost funds are better than owning many complex or speculative ones. Mutual funds are a great way to invest if you choose them wisely. Focus on discipline, cost efficiency, and long-term performance, not on flashy promises. For most people, investing in simple, low-cost index funds and holding them for decades is the most intelligent choice of all. Benjamin Graham tackles a question every investor faces at some point. Should I manage my money myself, or should I rely on professional advice? Graham's answer is thoughtful and balanced. He doesn't reject the idea of financial advisors, but he sets clear rules for how to use them wisely. Here's what he teaches. Know what kind of help you really need. If you're a defensive investor who prefers simplicity, you might only need basic guidance, not daily market advice. If you're an enterprising investor, you can still benefit from experts, but you must always make your own informed decisions. Be skeptical of predictions. Graham warns that most market forecasts from advisors, brokers, or analysts are worthless. No one can predict the future, not even professionals. A true advisor focuses on long-term planning and protecting you from emotional mistakes, not on guessing market movements. Watch out for conflicts of interest. Many advisors are also salespeople, motivated by commissions rather than your best interests. Always ask how they're paid and make sure their goals align with yours. Choose integrity and character over performance. An advisor's honesty, discipline, and calm judgment are far more valuable than flashy returns or fancy charts. You can use financial advisors, but use them as guides, not gurus. Their role is to help you stay disciplined, not to make decisions for you. A trustworthy advisor isn't there to make you rich overnight. They're there to keep you from making foolish mistakes. True financial wisdom comes from understanding yourself, not following someone else blindly. Benjamin Graham begins to teach one of the most fundamental skills in intelligent investing: security analysis, the process of determining what a stock or bond is really worth, rather than what the market says it's worth. Graham's goal is to show that you don't need to be an expert to think intelligently about value. Here's what he emphasizes. The purpose of analysis is clarity, not prediction. You can't forecast exactly where prices will go, but you can analyze whether a company is strong, stable, and reasonably priced. Focus on facts, not emotions. Study what you can measure: earnings, assets, dividends, and debt, not rumors or headlines. Simplify your approach. You don't need complex math or fancy models. Ask simple but powerful questions. Is the company consistently profitable? Does it have manageable debt? Is the stock selling for a fair price compared to its earnings? Use the margin of safety. Graham's golden rule: never buy a stock unless its price is significantly below its true value. This margin of safety protects you from mistakes, bad luck, and market downturns. Even ordinary investors can analyze intelligently by focusing on facts, fundamentals, and fairness of price. You don't have to outsmart the market. Just make sure you never overpay. You don't need to be a Wall Street analyst to be an intelligent investor. You just need curiosity, patience, and the courage to think for yourself. Because clarity beats complexity every single time. Benjamin Graham digs into one of the most commonly misunderstood numbers in investing: earnings per share, EPS. At first glance, EPS seems simple. It shows how much profit a company earns for each share of stock. But Graham warns that this single number can be misleading, even dangerous, if investors don't look deeper. Here's what he teaches: don't take EPS at face value. Companies can manipulate or smooth their earnings to make results look better than they are through accounting tricks, one time gains, or flexible definitions of profit. Always ask, are these earnings real and sustainable? Focus on long term averages, not short term spikes. A single year of strong profit doesn't prove a company is great. Look at least 5 to 10 years of results to understand its true earning power. Beware of temporary or cyclical industries. Businesses like steel, oil, or airlines may show huge profits during boom years, but collapse when the cycle turns. Earnings growth isn't everything. Many investors get obsessed with fast-growing EPS, but growth can fade quickly or come at high risk. It's better to buy a steady, reliable company at a fair price than a fast-growing one at an inflated price. Earnings per share are useful, but only when viewed in context. The intelligent investor looks behind the numbers to find the truth about a company's real earning power. Never let glossy reports or big numbers fool you. An intelligent investor always asks, what's behind these earnings? And can they last? To prove that the intelligent investor doesn't chase hype or glamour, they focus on facts, value, and long-term potential. Graham compares companies with very different profiles, some conservative and stable, others flashy and popular. He looks at their earnings, dividends, balance sheets, and stock prices, asking one simple but powerful question: is this stock a good value for what you get? And the results are surprising. Sometimes the most boring company turns out to be the smartest investment, simply because it's undervalued and overlooked by the crowd. Graham warns that popularity in the stock market is like fame in Hollywood. It fades. When investors rush into a hot company because it's trending or growing fast, they often pay too much. Eventually, the price collapses back to reality. Meanwhile, patient investors who quietly buy solid, underappreciated businesses often end up with better long-term results. In each company, Graham focuses on the fundamentals that matter most: earnings consistency. How steady are profits over the years? Dividends. Does the company share profits with investors? Financial strength. How much debt does it carry? Valuation. Is the market price fair compared to real earnings? He emphasizes that value isn't found in excitement, it's found in evidence. Graham's comparison teaches one central truth: you don't have to predict the future to invest well. You only need to pay a fair price for a good business today. The market will eventually recognize real value, and when it does, the intelligent investor will already be there, waiting patiently. The intelligent investor knows that real wealth grows quietly, backed by patience, logic, and discipline. Some people prefer a calm, low-stress approach, one that protects their money and delivers solid, steady returns over time. That's the defensive investor, someone who values safety, simplicity, and peace of mind over big risks or flashy profits. So, how should a defensive investor choose stocks? Graham provides clear, practical rules, timeless even today. Graham's first lesson is psychological. The defensive investor's first goal is to avoid serious mistakes, not to achieve extraordinary gains. That means don't chase market trends. Don't try to predict the future. Focus on companies that are proven, profitable, and financially strong. Here are the classic 7 criteria Graham outlines for the defensive investor's stock selection. Adequate size of the company stick. With medium to large companies, smaller ones are often riskier. Strong financial condition. Current assets should be at least twice current liabilities. A strong balance sheet. Earnings stability. No losses in the past 10 years. Dividend record. Uninterrupted dividends for at least 20 years. Earnings growth. At least a 1/3 increase in per-share earnings over the past 10 years. Moderate price-to-earnings ratio. The current price should not be more than 15 times average earnings of the past 3 years. Moderate price-to-book ratio. Price should be no more than 1.5 times book value. The defensive investor shouldn't rely on just a few stocks. Graham suggests building a diversified portfolio of 10 to 30 quality companies to reduce risk. Even the soundest company can face setbacks, so safety lies in numbers. The beauty of Graham's method is its simplicity. You don't need to constantly trade, time the market, or watch charts. You just need to select solid companies at reasonable prices and hold them patiently. The intelligent investor is not a speculator. He is a collector of sound businesses. But Graham warns from the start, if you want better results than the crowd, you must do something different from the crowd. That doesn't mean taking wild risks. It means thinking independently, using logic, and sticking to facts. Who is the enterprising investor? This type of investor is not a gambler, but they are more active than the defensive type. They are ready to study, analyze, and act when they find opportunities that others overlook. The enterprising investor spends time finding undervalued, overlooked, or misunderstood stocks, those selling below their intrinsic value. Graham highlights several areas where an intelligent, enterprising investor might look for value. Stocks selling for less than their true worth. Lesser-known businesses that are ignored by the market but have strong fundamentals. Mergers, acquisitions, reorganizations, or temporary problems that create short-term undervaluation. Bonds, or preferred stocks selling below par. Sometimes even fixed income securities are mispriced and offer opportunity. Graham insists that success comes not from luck, but from discipline and selectivity. He lays out a few golden principles. Demand a margin of safety. Never buy unless there's a clear gap between price and intrinsic value. Be skeptical of popularity. The more people talk about a stock, the less likely it's a bargain. Look for facts, not forecasts. Study what the company is doing, not what people say it will do. Stay patient. Real value takes time to be recognized, but it will be. An enterprising investor might buy a solid, low-debt company, trading at 60% of its book value. While others ignore it because it's not trendy, this investor waits patiently. When the market finally realizes its worth, the price rises, and the investor profits not from speculation, but from rational conviction. Activity alone doesn't make you enterprising. Intelligent activity does. He also reminds investors that emotional control is the real edge. Markets test your patience, ego, and fear constantly. Being enterprising means not reacting to the market. It means thinking when others are reacting. Benjamin Graham dives into a fascinating, yet often misunderstood, corner of the investment world: convertible securities and warrants. These instruments sit somewhere between stocks and bonds, promising the best of both worlds. But Graham, ever the realist, warns investors: what seems to offer the advantages of both stocks and bonds often ends up combining their disadvantages. What are convertible issues? Convertible issues are bonds or preferred stocks that can be converted into common shares at a predetermined price. Example: if you own a convertible bond, you get regular interest payments, but you also have the option to exchange it for stock later if the company's price rises. It sounds great: safety and potential growth. But Graham reminds us there's no free lunch in investing. The investor often pays too much for that privilege. Convertibles tend to offer lower interest or higher prices than ordinary bonds, meaning you sacrifice income or overpay for optionality. What are warrants? Warrants are like long-term options that let you buy a company's stock at a fixed price for several years. They're usually issued as a sweetener, a bonus to make a bond or preferred stock more attractive. However, Graham calls them speculative by nature. They don't guarantee income, and their value can collapse quickly if the stock doesn't perform as expected. A warrant is not an investment. It is a speculation wearing the disguise of a security. Graham isn't against them, but he urges caution. Convertibles can make sense only if bought at a fair price with solid underlying companies. Never pay a premium just for the option to convert, because the excitement of that potential usually fades faster than investors think. Warrants, on the other hand, rarely fit into a serious investor's portfolio. They're too dependent on market optimism. His timeless advice: the intelligent investor never buys hope, only value. Theory is nothing without practice. By studying actual cases, Graham shows how the intelligent investor navigates real markets, avoiding mistakes and finding opportunity. Graham examines 4 companies with very different fates. A conservative, stable company delivered steady earnings and dividends over decades. Example of a defensive investor's dream: predictable, low risk, long-term growth. A high-flying speculative company popular and hyped by investors, with rapid price increases. Ultimately, overvaluation and poor fundamentals led to disappointing results. A company in temporary distress faced short-term difficulties but had solid fundamentals. Demonstrates opportunity for enterprising investors who can analyze and act patiently. A highly leveraged, risky company, strong earnings on paper, but burdened by debt. Serves as a warning: appearances can be deceiving. Graham draws several timeless lessons. Don't chase popularity or excitement. Look behind the numbers: earnings, dividends, debt, and cash flow. Tell the real story. Margin of safety matters. Always buy at a price below intrinsic value to protect against mistakes. Patience pays off. Both defensive and enterprising investors succeed by holding and waiting. Even stable companies can temporarily decline in price. This is not a reason to panic. Speculative companies may seem attractive, but high risk rarely rewards the uninformed investor. Temporary distress can create rare opportunities for those willing to do research and stay disciplined. Intelligence in investing is not about predicting the future. It's about understanding the present with clarity and acting wisely. 2 companies may seem similar at first glance, but deeper examination, looking at earnings, dividends, financial strength, and price, can reveal which is a better investment. This method teaches the investor to avoid being swayed by appearances or hype. Price matters more than popularity. A hot stock with high price may be far riskier than a stable, undervalued one. Dividends indicate quality and reliability. Companies with long, steady dividend histories often outperform in the long run. Debt is a double-edged sword. Even profitable companies can fail if over-leveraged. Consistency beats short-term performance. A few strong years of earnings don't make a good investment. Look for sustained performance over many years. By carefully comparing companies, investors gain an edge. They can choose the better company at a fair price, reducing risk. They avoid emotional decisions, like buying because everyone else is, which often leads to losses. Graham emphasizes that intelligent investing is about discipline, patience, and evidence-based decisions. Benjamin Graham discusses a topic that is crucial for every investor: how a company handles profits and dividends, and the relationship between shareholders and management. He emphasizes that a company's dividend policy reflects both its financial health and the management's integrity. Dividends are not just cash payouts, they signal stability, discipline, and transparency. Companies that consistently pay dividends demonstrate financial strength. Management that prioritizes reasonable dividends shows respect for shareholders. Conversely, companies that retain all earnings for aggressive expansion may appear growth-oriented but often increase risk for investors. Look for a consistent dividend record. Avoid companies that frequently cut or skip dividends. Moderate payout ratio is ideal. Too high, risky if profits decline. Too low may indicate poor return to shareholders or wasteful reinvestment. Investors should monitor whether management acts in shareholders' best interest, not just chasing growth or personal gains. Some earnings can be reinvested profitably, but shareholders should also receive a fair share of profits. Graham highlights that dividend policy is a reliable indicator of management quality. Conservative, disciplined management, steady dividends, controlled reinvestment. Aggressive or speculative management, erratic or no dividends, over-leveraged projects. A good investor uses dividends as a signal of long-term stability and risk management. Benjamin Graham introduces the most important principle in investing: the margin of safety. This concept is simple yet profound. Always invest below the intrinsic value of a stock or bond. This buffer protects you from mistakes, bad luck, and market volatility. Graham stresses that risk is inevitable, but intelligent investors limit risk by buying at a discount to real value. What is margin of safety? Think of it like buying a house worth $300,000 for $200,000. Even if the market fluctuates or problems arise, your investment is protected. In stocks and bonds, intrinsic value is based on earnings, dividends, assets, and financial strength. The margin of safety is the secret of sound investment, not speculation. Why it matters: protects against errors. Nobody can predict the future perfectly. Mistakes in analysis or unforeseen events can occur. A margin of safety absorbs these shocks, reduces emotional stress. Buying at a discount prevents panic when markets fluctuate. Focus on value, not price movements. Short-term price changes are irrelevant if you own assets below intrinsic value. Defensive investors choose high-quality stocks or bonds well below intrinsic value. Enterprising investors seek overlooked opportunities with large margins of safety, especially in distressed or temporary situations. Graham warns against paying full price for any security. Doing so eliminates protection and increases risk. Graham reminds readers that investing is both art and science. Science provides the tools to evaluate value. Art is about temperament, patience, and rational judgment. If this episode lit a spark of inspiration inside you, hit subscribe, share it with someone who's ready to grow and change, and most importantly, take that first step toward becoming an intelligent investor. From this very moment, your journey towards smarter, safer, and more powerful investing begins. And remember, your financial future is built on the choices you make today.